Welcome in lecture number 4 in risk management course. In this lecture we will discuss market risk. In this chapter we will discuss the nature of market risk and which appropriate model to measure market risk. There are many models we will discuss in this lecture: risk matrix, historic or back simulation, and Monte Carlo simulation, and how we can to link between market risk and capital requirement according to Bank International Settlement, BIS. In beginning, what is the market risk? Market risk is the risk of loss that's associated with the change in market prices. The main implication for market risk to focus on measurement of the exposure and help us to make control techniques for credit market risk and employee credit risk. Market risk is uncertainty risk from change in the market price. But there are many factors or many risks affected on market risk, affected by interest rate risk, foreign exchange risk. Now, how we can to measure market risk? We can measure market risk over a period as short as 1 day. Usually, we measure market risk as term, dollar, exposure, or a relative amount against some benchmark. The important in terms of market risk, in the first for management information. When we measure market risk, that will help the management to make the decision. Also, main idea in market risk measurement, the risk and return trade-off. If there is high risk, will be high return. Also, market risk measurement help us to evaluate the performance. And regulation. Many regulations require to measure market risk. As Bank International Settlement, BIS, the market risk via capital requirement, leading to potential for overpricing of risk. But some regulation allows to some banks, example large banks, to use some internal model to calculate capital requirement. Calculate market risk exposure. Generally, market risk concerned with estimated potential loss under adverse some conditions. The first model to measure market risk, matrix model. The main idea in matrix model, that's to determine the daily earning at risk. The daily earnings at risk equal dollar value of position multiply price sensitivity multiply potential adverse move in yield. Or another equation for calculate daily earning at risk, dollar market value of position multiply price volatility. price volatility equal price sensitivity of position multiply potential adverse move in yield. Daily earnings at risk can be stated as modified duration multiply potential adverse daily yield move. Now, confident intervals, if we assume that a change in the yield are normally distributed, we can construct confidence intervals around the projected daily earning at risk. Other distribution can be accommodated by normal is generally sufficient, assuming normality 90% of the time. The distribution will be within 1.65 standard deviation, whether positive or negative standard deviation. Now, that means 5 of external value remains in each deal of the distribution. Only a 5% that's chance at 7 years will move up more than 16.5 basis point. In this case, we suppose that we are long in 7 years with zero coupon bonds. And we define bad yield. It changes such as there is only 5% as chance of yield change. Band exists in either direction. We assuming normality 90% of the time yield changes will be within 1.65 standard deviation of the mean. Now, if the standard deviation is 10 basis points, this corresponds to 1.65 standard deviation with basis point concern is the yield will be rise. The probability of yield increase more than 1.65 basis point is 5%. This is as chance. Example for calculate daily earnings at risk. Now, daily earnings at risk equal market value position multiply price volatility. If we assume yield on the bonds 7.24% and modified duration 6.52. For calculate daily earnings at risk, we need to market value of position and price volatility. If we assume we have market value of position $1 million, now we need to calculate price volatility. Just we will apply the equation price volatility equal modified duration in this case 6.5 multiply 7.2 will equal 10.77%. The daily earnings at risk will equal $10.77. Now, when we calculate or when we need to measure market risk, there are many factors or many risks evicted on market risk, as foreign exchange. In this case of foreign exchange, daily earnings at risk is computed in the same vision we employed for interest rate risk. In this case, daily earning at risk will equal dollar value of position multiply foreign exchange rate volatility, where the foreign exchange rate volatility is taken as 1.65 standard deviation. Equities. For equities, total risk equals systematic risk and unsystematic risk. If the portfolio is well diversification, then daily earnings at risk will equal dollar value of position multiply stock market return volatility, where market volatility taken as 1.65 standard deviation. But if we observe the diversification was not good, a degree of error will be built into daily earnings at risk calculation. Aggregating daily earnings at risk estimates cannot simply sum up individual daily earnings at risk. In order to aggregate the daily earnings at risk from individual exposure, that's require the correlation matrix. The first model for measure market risk, matrix model. Second model, historic or back simulation. This model based or focused on the past data. For that, the basic idea, revalue portfolio based on actual prices return. Only the assets that exist yesterday, the day before that, usually previous 500 days. Then calculate 5% worst case 25th lowest value of 500 days outcomes. The 5% outcomes were lower. Estimation of value at risk. If we convert today foreign exchange position into dollar for measure sensitivity of each position, we need to calculate its delta, measure the risk based on the actual percentage that change in foreign exchange rates for each of past of 500 days. The rank days by risk from worst to the best based on 500 days. Historic or back simulation depended on the past. For that, main advantage for this model is very simple. We don't need correlation or standard deviation, but in matrix we need standard deviation. Also does not require normal distribution of return and directly provide a worst case value based on the past data. But main disadvantage for this model, we depend on only 500 observations. We depend on the past 500 days, 500 observations. 500 is not very many from statistical standpoint. Also, increasing number of observation by going back further in time is not good. Also, good with recent observation more heavily and go further back. Third model, Monte Carlo simulation. Now, in historic model, we based on the past, we based only 500 observations. This was a problem. Now, in this model, to overcome problem of limits number of observations by add some observations. In this case, perhaps 10,000 real and synthetic observations. Employ historic covariance matrix and random number generating to synthesize observations. The main objectives is to replicate the distribution of observed outcomes with synthetic data. Now we discuss three models for measure the risk. But there are some regulation requires some models to measure the risk. According to Bank International Settlement approach, market risk may be calculating use specific risk charge, general market charge, but subject to these regulations, some largest bank maybe use some internal model to measure market risk, also to determine capital requirements. Bank International Settlement model focused on specific risk charge, general market risk charge, vertical offset, and horizontal offset. Now, in this lecture, we discussed the importance of market risk, and we discussed three models: matrix model, historic model, and Monte Carlo model. Also, we referred to some regulation according to Bank International Settlement to measure capital requirements and to measure market risk. Thank you for your attention for this lecture, and see you in next lecture.